I'm Steve Orland's president of the National Committee on U.S. China Relations, and I'm broadcasting from Manhattan, which we hope is the former epicenter of the coronavirus epidemic. Needless to say, the human tragedy of the epidemic is what people are focusing on, but there is an economic tragedy that we're also experiencing. Obviously, this morning, Catherine and Mark Zandi will discuss it soon. We had an announcement of GDP contraction of 4.8%, which she and he will talk about. This is the first of a series of 3 programs that we're going to do on U.S.-China economic relations. The next one is prospects for U.S.-China economic and trade relations in the coronavirus crisis. And the next one will be on May 27th and will be prospects for U.S.-China cooperation in combating the global economic downturn in the coronavirus era. That will be on May 27th from 10 a.m. to 11:30 a.m. and the sign up will be sent out soon. Well, we're thrilled to kick off this program with 4 of the world's outstanding economists. We have first in Beijing, we have Shanwen, who's the chief economist at Essence Securities. And in Hong Kong, we have Huang Yiping, who's a professor of economics and deputy dean of the National School of Development at Peking University. And on the US side, we've got Mark Zandi, who will join us very shortly, who is the chief economist at Moody's Analytics, and Catherine Mann, who is global chief economist at Citibank. They're each going to speak for between 5 and 7 minutes. I'm going to ask some questions, then I'm going to open the floor to questions. But thank you all for joining us. I'm looking forward to a very interesting panel where we can all learn a lot. Let me turn it over to Professor Gao for the first discussion of China's economy.
Okay. Thank you, Steve. Ladies and gentlemen, good morning and good night. I'm honored to take this chance to share some observations concerning China's economy during its fight against the pandemic. Firstly, as we all know, in Q1, China's output growth took an extraordinary plunge never seen before. When compared with the performance during the height of the global financial crisis, the drop in GDP growth rate is 4 times as big as in the financial tsunami, and the industrial output is 2 times as big. However, the drop in the general price level in Q1 was very modest and amounted to as little as 1/5 of what was recorded in early 2009. The degree of change in inflation rate in Q1 usually corresponds to less than 0.5 percentage rate of output slowdown during normal times. The sharp contrast between output and the price level unambiguously indicates that the aggregate supply was disrupted almost as severely as the aggregate demand was shocked, which cast a long shadow over the suggestions to restart and stimulate the economy from the demand side. Without the lift of the widespread lockdown measures the economy cannot work properly. Secondly, if we delve into the details of retail sales and consumer behavior, some important patterns will be laid bare. We may naturally assume that facing the pandemic, people have to keep social distance to control for infection peril. But online sales volume for many items also dropped conspicuously, which cannot be easily attributed to infection risks. In fact, only food and some other few necessities can manage to keep steady. At least in the short term, people were overwhelmed by fear and panic, and indiscriminately cut back all economic activities except what is absolutely necessary. As time dragged by, panic faded away and people cautiously began to spend again, and the economy was spontaneously reopened. However, given the lingering infection risk, people learned to adapt to and differentiate between economic activities, some of which was less risky and could be done with some simple protective measures, like online sales of telecommunication equipment or dinner outside, and some maybe of high peril, like public gathering and air travel, which had to be delayed to much further future. Anecdotal evidence suggested that China's consumers went out of panic and began to open their purse again by early March. The recovery in consumption so far is slowly but steady and may go on for a very long time until a new balance is reached. The behavior pattern of panic and adaptation may also apply to government and enterprises to a certain degree. Thirdly, the coronavirus hit the economy badly. Life for some sectors and some people are hit much harder than others. Unfortunately, low-income people are particularly vulnerable. During the past few years, employment in the secondary sector has been steadily shrinking, possibly reflecting the ongoing restructuring and upgrade of the manufacturing industries. As a result, all newly created jobs are in service sector, which are badly affected by the outbreak of COVID-19. As of 2018, employment in service sector stood at 350 million, which accounted for 47% of the total. Among the biggest employment subsectors are wholesales and retails, hotels and restaurants, and etc., which happen to be the biggest casualties of the pandemic. Loss of income without access to credit may have already forced those sectors, the employee in those sectors to tighten their belt. And the life for small business could hardly be better. Those hardships call for well-targeted aid package, which is reversible once the virus is eliminated or put under total control, which China's government is trying its best to do. That's all. Thank you.
Great, and right within the time limit. Yiping.
Thank you, Steve. Well, also on behalf of the co-organizer, the National School of Development at the Peking University, I'd certainly like to thank Steve to host it, but also like to welcome everybody to join today's event. Following on Shanwen's remarks, I like to add 2 points or 2 observations of my own. The first is about the policy responses during the pandemic. And the second is some of the likely implications to draw on the medium to longer term economic outlook. I like to categorize all the policy responses during the last couple of months into 3 groups. First is the efforts trying to control the pandemic, the spreading of the pandemic. The second is pain relief. And the third is the measures to stimulate the economy or reconstruction of the economy. As Smes mentioned earlier on, we're doing reasonably well in controlling the outbreak of the virus. And essentially, the only effective solution is really social distancing and even lockdown. We're not 100% sure this is a done deal, given that the virus is still spreading around the world. So I think the Chinese government is still cautious. But at the moment, we are adopting a so-called 2 hands policy. On the one hand, still want to be particularly careful about the potential risk of a rebound of the pandemic. But at the same time, we really needed to restart the businesses. And we actually saw a downgrade of the alert in Beijing today, which was quite welcomed by everybody. So that's almost been done, but we still need to pay attention to. The second part of the measure was really more pain relief. And the idea is just to help the companies and the households to go through this very difficult period. And I would say this is probably the core policy reaction this time around, compared to, for instance, during the global financial crisis 10, 11 years ago, when we had the big 4 trillion yuan stimulus package. And the focus really was on infrastructure spending. That might also happen going forward. There are some discussions at the moment, but the core measures we saw so far are mainly supporting the households and the SMEs, the small medium enterprises. The key reason is this, because economic activities suddenly came to a standstill, and SMEs really were under significant pressure. On the one hand, their revenues were substantially reduced. On the other hand, they continue to have to bear all with these the operating costs. And most of the SMEs did not really have a lot of cash reserves. So that's why the cash flow became a bigger problem. But that could become a systemic problem, because although we know the closing down of SMEs is a usual phenomenon, but in China, the SMEs, which really constitute the majority of the private sector, which accounts for more than 60% of GDP and more than 80% of the urban employment, which basically means if we see a big portion of the SMEs getting into trouble, it could be a systemic problem for the Chinese economy and even for the society. So that's why for the past couple of months, we saw measures from the central bank in terms of monetary policy, injecting liquidity, but also more targeted in supporting the SMEs. The fiscal policy, the government is trying to waive some of the social security contribution to reduce the rental yield, rentals, and also to subsidize the interest payment for the bank loans and so on. And even the banks, financial institutions themselves providing more support to the SMEs. So I think this was the main focus of the policy response. And the idea is that we are suffering from this really unexpected shock, and economic activities really slowed down. The idea is that we need to make sure that these enterprises and related households have enough cash flows and maintain reasonable balance sheet so that, number one, they can survive. And number two, when the pandemic is really put under control, economic activities could recover. And that's why I think the priority of this policy package compared to 10, 12 years ago was very different. Hopefully, we now gradually also coming to an end. The pain relief measures might give way to some of the measures to stimulate the economy, whether consumption or investment. There are lots of discussions about investing more in the so-called new infrastructure, technology-related infrastructure, investing in major metropolitan areas, and also investing in urbanization, especially for settling down of the migrant workers. So I think we gradually start to see shift, and economic activities, particularly investment, might pick up. My second observation is about more medium to longer term economic implication. Once this is over, what will happen to the Chinese economy? My number one takeaway is, as Smes mentioned earlier on, I think this recovery will be very gradual. Even though the pandemic is already put under control, the original expectation, like what we had during the SARS period, the pandemic we suffered 17 years ago. After that pandemic was under control, economic activities rebounded very sharply, the so-called V-shaped rebound. I'm not sure if we're going to see the same this time, mainly because we saw a lot of migrant workers went back to the coastal cities and to restart the operation of the businesses. But a lot of companies will actually have to start new holidays because they received cancellation of the export orders. i.e., if the pandemic is not globally controlled, the kind of support to economic activities in China, particularly the export demand, will remain weak. And so this will take a little bit longer for the recovery. Obviously, the government is going to do a bit more in stimulating investment, and that probably will be helpful. My other sense is that maybe consumption could play a more stabilizing role as we go forward. Retail sales in China is already as large as the one in the US, even though the consumer spending might still be relatively slow in terms of growth. But globally, that might be the bright spot in the second half of the year, or even maybe next year. So that's my first takeaway. Recovery is likely to be slow. It might actually be led by Chinese consumer. Number two, what was a little bit surprising that happened during the pandemic was the digital economy played a stabilizing role in terms of macroeconomic performance. So we know when you had the lockdown, activities all came to a standstill. But in many areas, the online activities actually picked up quite significantly. Some of the Chinese manufacturers suffered from a significant slowdown of activities, their sales, because their offline shops all shut down. But then a lot of them moved on to start online businesses that actually helped to offset some of the loss of the businesses. As Steve said, I'm a professor at the Peking University, and I've been staying in Hong Kong since the Chinese New Year. But I never stopped teaching my courses at the Peking University while students all learning online just like this. And it's just very difficult to imagine without this technology, without this infrastructure, we can continue the semester without a major disruption. So a lot of activities like this is really happening. And one area I've been spending a lot of time also working on is what I call digital finance, or the fintech, what you call using technology to extend loans online, remotely, and to the SMEs without the good historical data, without fixed assets to serve as collaterals, but they are helping millions and millions of SMEs around the world. So my expectation is, even after this pandemic, we might actually see a faster surge of digital economy, particularly in the Chinese economy, maybe also in the other part of the world. My third takeaway is that it looks like external economic relations might become a little bit more complicated. Now, it's very difficult to predict exactly what is going to happen. I think at the moment, especially with what is happening in the US, a lot of it might be related to politics. But we have been working with Steve, the National Committee of U.S. China Relations, on this track 2 dialogue. And we've been discussing about the so-called the potential possibility of having a partial decoupling. My question now is, I don't know the answer. My question now is, this partial decoupling, is this degree of partial decoupling going to rise a bit further than before the pandemic? That's an open question. My fourth takeaway is that, well, I think as we can all see during the pandemic, major global central banks are expanding their monetary policy in a very aggressive way. The Fed, the ECB, Bank of Japan, all said that they're going to engage in unlimited quantitative easing. IMF just announced some number to expect that the public debt as a share of GDP in advanced economies would rise from 105% to 122%. So it looks like monetary and fiscal policies are expanding very dramatically. And I think that's probably reasonable policy actions when you see major crises like this. The key thing we have to watch is what happens after the pandemic. My prediction is that exiting of this unusually expansionary fiscal and monetary policy will be very difficult, or at least very slow, which probably means once the pandemic is over, we probably will have to live with this extraordinarily easy monetary and fiscal policy conditions and possibly volatile financial market. That's something we have to be prepared for. Thank you, Steve.
Great. My first question actually was going to be for Yiping and Professor Gao, which is how do you think has the epidemic affected the implementation of reforms from the third plenum of the 18th Party Congress? That the perception in the United States is we haven't really, China has not really made progress. So has it slowed it even more? Is it hasn't it affected it, or has it sped it up?
Well, I'll have a quick go, and Simon can correct me. I think in general, that probably means the policy reforms will have to accelerate. And one of the good example, Steve, you heard, is that the government now is starting to focus on liberalization of the factor markets for labor, capital, land, and so on. And that actually has been a research topic for me during the past 10 years. My takeaway, looking at the Chinese reform approach, we always say it's a gradual reform approach. It's a dual track reform approach. But you look at the Chinese economy during the first 40 years, you find the product market has been completely liberalized. You think of markets for agricultural products, manufacturing products, the service products, they've always been freely determined by demand and supply, and the markets are freely determined in the market. Well, sorry, prices are determined by the market. But you look at the markets for the production factors, from capital, labor, land, even energy, and so on, in one way or the other, the government had lots of interventions in it. And my own research focused more on the financial sector. That sometimes I call asymmetric liberalization. Liberalization of the market was not complete. So it was good to hear that the government now is shifting toward the second part of the market, the factor market, the liberalization. And I think that will give the last kick to complete market-oriented reform. So in that regard, I think we're certainly seeing some acceleration. Simon?
Professor Gao, anything, Shanwen, you want to add?
I totally agree with what Professor Huang Yiping has said. Actually, as far as economic development is still very important for the government, it has to do something. And in the past 10 years, the government has exhausted the simple solution to boost the growth. That's by spending more money, by monetary easing, by fiscal stimulus. And those easy part has been exhausted, and because economic development is still supposed to be important, and the easy part has been exhausted, so the government has to turn to the hard one, which is to reform the system. And actually, in the past 2 years, we can see that the reform agenda has been gathering pace, and particularly if we look into the policy response during the pandemic, we can see that the consensus is growing that the reform agenda has to be accelerated further to fight the coronavirus.
It's interesting. It's interesting. Let's go to, Mark is still having trouble getting on, so we'll go to Catherine, but let me, and have her speak next. But I think an interesting point is kind of the US is going the other way, where the state participation, the government participation in the economy is absolutely enormous, picking winners and losers, funding some, not funding others, potentially taking equity stakes in companies. Catherine, can you hear me? And
yes, I can hear you. So I'm going to try to wear two hats here, a little bit on the US hat, and then also wear a global hat until Mark comes in from wherever he is in the digital Netherland. So let me start with the global, just because I think it is important to have a backdrop of where we are, or where we think we are in terms of our projections. We start out with basically we're looking at a global contraction that is the greatest since the Great Depression. There have been only 2 times since the 1960s that we've had negative GDP growth in the global economy. The GFC was the first one, and now we have this one. The depth of the recession, the depth of the global contraction is unprecedented in living memory, unless you have really, really old relatives. And the pace, the going off of the cliff, so the pace of the deterioration is also unprecedented. In terms of lost GDP, we're currently looking at $7, perhaps even $8 trillion worth of lost GDP. So in some sense, you have a global economy that really is on the ropes. So the question is, what is going to be the shape of the recovery? We are looking at, Q1 was the bottom for China, Q2 being the bottom for most of the Europe and the US, maybe some Q3s when we think about Latin America and some of the other emerging markets. So we're probably at the bottom now. So the question is, what is the shape of recovery going forward? What does the trajectory look like? And so we have an alphabet of recovery letters. The V, well, first there's the W, there's the V, there's the L, and then there is the reverse J, or what is also known as the swoosh. So how do we get to those different alphabet letters? The implications of those different alphabet letters are very significant when we think about the duration of the duration of the period of time where we are still below the level of GDP that we were at in January 2020. I mean, the reference point here is January 2020 was, now we're referencing it, that is the peak. That is the peak of the cycle. And how long does it take us to get back to the peak of the cycle? Because all of the time in the meantime, you are in a position where you have, if you're a company, your revenues haven't recovered. If you're a country, your GDP hasn't recovered. And so you have a situation where your per capita GDP is deteriorating as well. So the pace of recovery really matters. The V-shaped recovery is the one that is usually used to describe a manufacturing type of environment where you shut down a factory, you run down your inventories. Then when a factory opens up and demand recovers, you rebuild your inventories. Professor Yiping has already noted, and Professor Zhao as well, has already noted that global demand is very weak. And so depends on global demand, that automatically starts to attenuate the V in a manufacturing hypothetical. The second group of, second alphabet letter is the L. The L is associated with the services sector, particularly consumer discretionary services and services that require proximity. So, I mean, we're all here, as Professor Yiping was saying, he taught his classes. We're here doing this webinar. I happen to be at a different location than normal, but I'm still doing the same stuff. So those services have been proceeding without any problem, really, essentially. But there are a lot of the ancillary services that go along with students going to university. There's a lot of service, cafeteria and going to the bookstore, and I think some people buy books. Those sales are gone, and they are never going to be made up. Consumer discretionary services having to do with travel, tourism, restaurants, entertainment. Those services and those activities are never going to be made up. And so that represents an L-shaped deterioration for that part of the services sector in an economy. And so the more we have those types of non-storable services being attenuated because of period of time in shutdown, the fear factor, do I really want to go out to a crowded place, even if it's a great, and do I want to go travel? When those issues have to do with consumer choice and consumer behavior, but it may also be the case that there are recommendations or even requirements, regulations for enforced social distancing in those types of activities. So it may be that restaurants are allowed to open, but only with half as many tables. And it may be that theaters reopen, but only half as many seats can be filled. And so that is a permanent, again, a permanent loss in revenues and employment associated with those activities. I may be going back to play. We call this going back to play. But all the workers who are supporting my leisure activities, they are not going to be employed. And so you have a continuing drag on the economy for much longer than I think people think is going to be the case. And I am listening very carefully to our Chinese commentators because China is the template for data. It's the first place that had the virus. It was the first place that undertook the policies of shutdown, and it is the first place that has opened up. And so to watch how manufacturing is changing or industrial production is changing, and also to watch what is happening to discretionary consumer behavior, that is a very important indicator of what is on the horizon for the U.S. economy, for the European economies, and therefore for the global economy. So we end up with an environment where the likely long, slow recovery is one that keeps us from reattaining the January 2020 peak for an extended period of time. And all of that time period, you've got companies who are not investing, except for digital, which is countercyclical. We do see that in the US data. We see it in data for other countries as well, that companies are continuing to invest in digital, even as sort of traditional CapEx has really fallen apart. So you have sectoral differences in terms of winners and losers, but for the economy as a whole, both the US economy and going on for the global economy as well, very slow recovery. Companies, by and large, not investing. You have the problem of shutdown of business or bankruptcy of business, shedding of workers, and so forth. And that, of course, is where the policy initiatives, the PPP and the stimulus checks and additional unemployment compensation, all of these are designed to try to keep businesses and consumers whole until the economy reopens. I think the problem is that it may take a long time, a very long time, 12 months, 18 months, to reattain the previous GDP peak. And all that time period is way too long for the current fiscal packages that are in place to continue to be implemented. Monetary policy, the comment has already been made, how global central banks are expanding their balance sheets. These are, in the context of the Federal Reserve, a policy put on basically any type of financial asset. But there's a real question to what extent the monetary policy and the support that it's providing the financial sector necessary, because otherwise we would have had first a COVID shock, and then secondly, a global financial crisis 2.0 shock. So the Fed and other central banks are doing what they have to do. But it does mean that the question remains, do the efforts that they have put into place, do they get beyond the support of the financial sector? Do they ultimately get to support the real economy? Right now, I think what we can say is financial markets are buoyed up by these policy initiatives, but they are looking through 2020 completely. They think of that as a lost year. They're looking through to 2021. So there is a disconnect that is going to be in place for another year between what the financial markets are saying about prospects for the economy and what the real data say about prospects for the global economy. And so how long that sort of financial levitation can last, I think is a really important question. And what are the optics and what are the other policy challenges that come when you've got financial markets levitated relative to the real fundamentals? We know that there are inequality issues associated with that, and those are going to perhaps become even more apparent over the next year. The last point that I'll make is on inflation, because it did come up, a couple comments on inflation. What we have right now, again, is tremendous disconnect between financial market metrics of inflation expectations, as for example, we look at the two-year inflation swaps, as compared to consumer expectations of inflation, which are very much being driven off of food prices, and business expectations for inflation, which of course comes from their ability to raise prices or to be required to take discounts. So you have financial markets saying that there's no inflation. You've got consumers who are saying, my expectation is that inflation is going to rise. And then you have businesses saying, I have to discount all of my products. So that disconnect, again, between the financial world, the consumer world, and the business world is ultimately going to have to be resolved. And there's going to be a lot of turbulence in terms of financial assets, particularly bond prices, I would imagine, as those inflation expectations merge. So bottom line is, bottom line is first, very long pace of recovery. So it's an elongated L with a lot of losses, that revenue losses in consumer discretionary sectors that are not going to be made up. Getting to the previous peak, maybe in 12 months if we're lucky, could be longer than that. Number two, disconnects between what we see happening in industrial production and what we see happening in consumer discretionary. And number three, these disconnects between financial markets and the real economy. We observe that on asset prices relative to fundamentals and on different metrics of inflation.
Great, thanks. Is Mark now on?
Steve, I am on. Can you hear me?
Yes, great. We can see you too now.
I apologize for that. Been a crazy morning. I'm sure for a lot of folks as well. Thanks for having me, and it's good to be with you. And thanks for the opportunity to present to the group and to all the participants. I'll make 3 points in my remarks. Point number one, maybe a hopeful point. I think we are now at the apex of the shock to the global economy. Literally right now, this month, April will be the very worst of the hit to the global economy from the COVID crisis. The hit is really two blows. First is a supply side blow, and that goes to the shutdowns of businesses in many parts of the world. Here in the United States, we calculate that roughly 1/3 of the nation's economy is on shutdown and can't work, and gives you a very clear sense of how disruptive that is. There's also a demand side shock, clearly, given all of the lost jobs, lost wealth, the uncertainty created by the crisis, and the effect that's having on business expansion, hiring, investment decisions. And also, of course, the disruption this is creating to global trade and investment. The demand side shocks are quite considerable. Just to give you a sense of magnitude, here in the US, we got a data point this morning. You may have already been talking about it. GDP in the first quarter, US GDP in the first quarter fell almost 5% annualized. That probably understates the case. There's a lot of measurement issues, particularly in this kind of economic environment. If you go back, for example, to the financial crisis, at the apex of that crisis back in the fourth quarter of 2008, the first GDP estimate for that quarter was down about 4%. And then ultimately with revision, it was double that, down 8%. And I suspect that's going to be the case here as well. We're also going to see the magnitude of the shock evident in the labor market data. We'll get that data point next week. It'll show that the U.S. lost 20 to 25 million jobs in the month of April. Just for context, there's 150 million people in the workforce, so very considerable. Unemployment will go to 15 to 20%, and that understates the case because to be counted as unemployed, you need to be out of work and searching actively for another job. Of course, that's not practical for many people. They just can't search. So they'll be not counted as unemployed. But underemployment, which would include those folks, will be over 20%. Again, for a little bit of historical context, you have to go back into the 1930s Great Depression period for that kind of unemployment. The all-time high unemployment rate was back in 1933 at 25%. So the orders of magnitude here are quite considerable. I do think, though, that this is the apex of the shock because businesses are starting to reopen. Whether that's a good idea or a bad idea, we'll find out from a health perspective, and whether we get new infections, second wave hotspots seems like a real risk, and I'll come back to that. But we are going to open, and you can see a lot of governors across the country just moving very quickly here. And so I do expect business reopenings in May, June, and by my guess is July 4th, that's early July, most businesses will be reopened, except for those where you have to bring large groups of people together, which they'll remain largely closed until we have a vaccine or some form of treatment. The other reason for a little bit of optimism that we are at the apex is the fiscal and monetary policy response globally. It's been very aggressive, and hard to fault policymakers for how quickly they've moved here and how aggressively. Here in the US, the Fed has thrown everything they have at this. They've now erected what feels to be a pretty good firewall between what's going on in the real economy and the financial system. Obviously, zero interest rates, lowered capital reserve, liquidity requirements on the banking system, buying lots of bonds, all kinds of credit facilities, and it's worked. The stock market has recovered a lot of its losses, credit is flowing, and that should help to support growth. On the fiscal policy side, lawmakers have passed 4 pieces of legislation totaling about $3 trillion. In total, it's 15% of GDP. And there's execution issues, but broadly speaking, that's a lot of money being pushed at the economy. And thus, I think we will see an economic recovery begin as we move through this quarter into Q3. Second point, I don't think the recovery is going to be strong. It's not going to be V-shaped, as I think clearly the administration has been hoping for. Hard to imagine that this economy is going to kick, or any global economy is going to kick into gear and get right back on the rails. First, there's just the uncertainty around the trajectory of the virus. Hard to imagine that there aren't going to be some steps back here with regard to new infections across the country. And I wouldn't be surprised if we see some parts of the country re-shut down. And even if I'm wrong and things turn out better than anticipated, the uncertainty around this is quite considerable. I just don't see businesses and people fully engaging, doing what they normally do for a long time until they feel very comfortable that they're not going to get sick. And businesses, they're going to be planning for second waves and shutdowns. And given that context, I can't see them investing to any significant degree. In fact, here's just a quick factoid. We run a survey of businesses globally every week. We've been doing it since '03. One of the questions is around investment. And last week, not a single respondent, 0 respondents said they were investing in their business. That just gives you a sense of magnitude. Even in the depths of the financial crisis, 20, 25, 30% of businesses were saying that they were investing. So I think the uncertainty is just overwhelming. Also, weighing on the recovery is the fact that we will see significant business failure and bankruptcy, despite all the support from the government to keep businesses moving forward. It's going to be very difficult to help, particularly smaller businesses. They just can't avail themselves of the government support, and the programs that have been put in place aren't particularly effective at getting to those smaller businesses. And that means a lot of people just won't have a business to go back to when the businesses are reopened by governors. And so I just don't think we're going to be able to see unemployment come back in very quickly because of all those business failures. There'll be other credit problems, bankruptcy, delinquency, default, ultimately foreclosure. It's delayed because of various forbearance programs, but there will be more foreclosure. And we're going to have to work through all of those issues, and that's just going to weigh on the ability of the economy to grow. And then to reinforce a point that was made earlier, historically, when you look at recoveries coming out of recessions, you have one part of the world that is kind of leading the way out, the engine that drives the global economic train. China played that role coming out of the financial crisis. No one's going to play that role this go around. This is a global downturn. Not a single global economy is going to navigate through this without some form of recession. So there's no engine driving the train. So point number 2, this recovery is going to feel, it's going to be a slog. And if I had to pick a letter or shape, it'd probably be that Nike swoosh that Catherine was talking about. I don't think it's going to be a V. Finally, point number 3, it's going to take a long time to recover from this fully. This is going to have this COVID crisis is going to have a long, dark tail. And I don't expect, even under most scenarios and assumptions about the trajectory of the virus and the policy response and all the other things that can go wrong, assuming nothing really does go wrong, else goes wrong, it probably won't be until mid-decade until we're kind of back to something we feel very comfortable about. I'll mention 2 big things that we'll need to work through that are going to make it difficult for the economy to not be diminished by this. The first is the debt and debt loads that are now mounting very rapidly because of the policy response. Now, I'm not arguing that the policymakers shouldn't be aggressive here. They need to be. They have to respond. If they don't, then the economy and the fiscal situations will be much worse. So there's no choice, but it's a Hobson's choice. There's no good choice. and governments are leveraging up very rapidly. Here in the United States, the nation's debt to GDP ratio is going to go from 80% publicly traded debt to GDP to over 100% by this time next year. And we're headed to 120% very quickly. And I just mentioned that number because that's the all-time peak for US debt that we achieved in the wake of World War II. And we're the AAA credit on the planet. Other economies, countries are going to have a great deal of difficulty navigating through the high debt loads that prevail. And that's going to take a lot of hard work, and that's going to weigh on global growth for a long time. And then finally, I do fear that this event is going to further stymie, if not for a while, short circuit globalization. I mean, obviously globalization has been on its back heels here for a while under the current administration. When I say globalization, I mean trade, I mean immigration, I mean foreign investment. And it's going to take a long while, I think, before economies, countries, including the United States, open up again, even under different leadership. And that means that we will be diminished by this. Globalization has been a key driving force for increasing global living standards and economic growth. And that it's hard to imagine we're going to get back to the kind of globalized economy we had anytime soon, and COVID-19 is going to make that even more difficult. So, Steve, sorry, I didn't really mean to end on a down note like that, but it just kind of ended that way. So, sorry about that.
You started off saying, well, I'll start off with a little bit of optimism. I guess yes. You've answered a bunch of the questions which I was going to ask, but you've raised a question which I then would like to direct to the other three panelists, which is that this is the apex of the economic downturn, that this is, it won't get better fast, but it will get better. So I'd like to ask Catherine if she agrees with that. And then Yiping and Shanwen, when was the apex in China's downturn? Has it turned the corner? And then what are going to be the factors that affect whether the shape of this recovery? So let me start with Catherine and then go to Shanwen and Yiping.
So I think there's a degree of specificity that is, as somebody who kind of tries to avoid point estimates, thinking about the confidence intervals around data. I'm not sure I would want to be so explicit as to say that April is the worst month. I think it's too early to say that April is the worst month. And that's because I think that there's still a number of places around the world that are still experiencing the beginnings of the virus and the beginnings of the policy response. I think that there is this pace of recovery, the importance of the services sector, the consumer discretionary sector, and general consumer spending and potential business bankruptcies. All of these, I think, are going to make May look and perhaps feel as bad as April. So I think it's too early to say that April is the worst month. And I think we have to be conscious that different paces in different parts of the world means that it's very difficult to pinpoint when you see the bottom. As I say, I think we have to be a little bit conscious of this is not one crisis happened in one place at the same time or many places at the same time, because it has this sequential nature to it, because there are these reinfections concerns and actuality. I think it's premature to say that April's the worst month.
Yiping and Shanwen, what about in China? When was the apex? What's going to determine the speed of recovery?
Well, in general, I'm sympathetic to both Mark and Catherine. I think if you look at the global economy, the Chinese economic recovery would be to some extent dependent on the recovery of the global economic demand. But I guess given that the nature of the global crisis, at the end of the day, resumption of economic activities globally might be determined by the weakest link of the chain, which we don't know yet where the virus is going and how bad it might actually go. If we're talking about the domestic economy in China, I do think the worst is probably behind us. Cities one after another is gradually opening up. And so I think we're going to see probably more activities. Consumers gradually start to spend more. And even in many areas, the local government might take some action, making investment in the fixed asset investment. So if you look at a quarter-on-quarter basis, I think the second quarter certainly could be better than the first. But so in terms of the worst point, it might already be behind us, but we're not sure how quickly it will recover. I think the trajectory will be very complicated, particularly given the openness of the Chinese economy.
Shanwen, anything you want to add to that?
I agree with Professor Huang Yiping that the worst for China is already behind us. I think the worst is late February or as late as early March. And ever since then, the economy has turned over. And the key factor is how fast the government can put the infection under control. And the indicator is the newly infected numbers every day, and which peaked in early February in China. And gradually, the government and the consumer gained the confidence that this is put under control. And the second, the less important factor is how fast and how effective the consumer and the enterprise can manage to strike a balance between doing business and the prevention of the infection risk by taking some protective measures. And gradually, people went out of panic and learned to adapt to the new environment with some very innovative measures to prevent the infections. And because of mainly those two key factors, China turned around the corner in later February or early March. Thanks.
Mark raised the point, which I think about a lot, which is the ratio of public debt to GDP. This speed of increase, and we've always talked about it in terms of China, but now obviously we should be talking about it in terms of the United States. So first for Mark and Catherine, and then for Yiping and Wenjiang, how do we repay this debt if treasuries are now at historic lows? If at this level of debt, if treasuries started to tick up, the budgetary implications of this on an annual basis are simply enormous. And what does it mean America will look like? Will tax rates go up to 7, what they were in the 50s, 70, 80% on individuals? How does America deal with this? And then the same question for the Chinese panelists. These debt rates are not sustainable. And you see in the U.S. process, they first were talking about, after the initial program, they were talking about 200 billion. Then overnight it was 300 billion, then 400 billion, and ended up close to 500 billion, with some of it not even related to coronavirus bailout. I mean, the irresponsibility of the legislative branch when you read those stories on the stuff that was legislated and adding to the debt, it took my breath away. So first Mark and Catherine, and then Yiping and Professor Gao.
Catherine, would you like me to take a crack at it?
Sure, I'll follow you.
Okay. Well, Steve, I'd say maybe just because this is my approach in this conversation, I'll start optimistically first. Two things that will buy us some time. First is the Federal Reserve is going to continue to buy bonds, and it'll buy whatever is necessary to ensure that long-term rates remain low for as long as they need to remain low. So the entire Treasury yield curve is now managed by the Fed. So it's not a market interest rate, it's a managed interest rate.
Mm.
And my guess is, my sense is they're kind of managing the 10-year yield to be somewhere 0.5 to 0.75%, somewhere in that range. So if it gets up above 0.75, closer to 1, they buy more bonds, that kind of thing. And I think they'll expand the balance sheet to do that for as long as necessary. The second thing, optimistic thing I'd say is, we've got our debt problems, but the rest of the world have much bigger debt problems. I mean, even if we go to 120% debt to GDP, we have the capacity to support that relative to the rest of the world. It's kind of like that if you're running with your colleague or a friend, and there's a tiger chasing you, all you need to do is outrun your friend, kind of thing. At least until the tiger eats the other guy, and then you're up next. So that buys us a little bit of time. Having said that, I do think we will need to address this on the other side of the virus when the economy is growing again in a consistent way, unemployment's declining, and hopefully this time when we do that, unlike after the financial crisis, we are fiscally disciplined, that we do raise taxes and we do restrain spending and slowly bring down the debt level over time. After World War II, when we had 120%, it took us a good solid 3 decades to get it back down to something around 35, 40%. And that's the kind of thing that if you were a planner looking from 30,000 feet and saying, how would you want to do it? That's how you'd want to do it. Every single year, you kind of bring it down a little bit. But that's going to be difficult, not easy. The political constraints here are going to be quite considerable. And I'll say one final thing. I think the only way we get the political will to address it is for actually interest rates to rise. Because if people can't connect the dots between the deficit's debt and what it means for the economy, we're not going to ever generate the political will to do the things that we need to do until it's too late. So at some point, the Federal Reserve has got to allow rates to rise. We're going to have to suffer a little bit, and everyone's going to have to be able to connect the dots. Kind of sort of what we did, back, you can remember back in the 80s and 90s, even through the early 90s. Remember Bob Rubin, who's part of this group, did an admirable job of connecting those dots for the American people. Clinton administration, whose inclination was to expand deficits, actually went the other direction, and we ended the decade with a surplus. And the worry at the time was we're going to run out of Treasury bonds. Remember Alan Greenspan testifying in Congress about that. So hopefully it's going to take some very deft policymaking and political gerrymandering, but hopefully we find the political will to do that. Otherwise, we're going to be in a world of hurt at some point down the road. Yeah.
Bob Rubin is speaking on the 27th in the
is he?
third
Okay.
of this, May 27th on the third of this series of programs. Catherine.
Yeah, so I also was going to recall the history of Rubinomics, but let me say a couple of other things. First, we have a tendency to focus on debt to GDP as the sustainability criteria for countries or for companies. Non-financial debt to revenues is another way of thinking about it. I really think that we have to have a broader set of metrics to determine sustainability, because after all, debt is a stock and GDP is a flow. And with regard to other things like mortgages, we would never look at the mortgage on a house relative to my income. Instead, we look at debt service capability. So what's the flow of debt service requirements relative to the flow of our earnings? And so along that metric, then we start to be able to see the direct relationship between monetary policy choices and monetary policy decisions to keep interest rates low. Well, why do you do that? It's in order to keep debt service within sustainable bounds. So I think that's the first issue that we have to address. The second one is, again, going back to our history, there was a period of time when debt service as a share of GDP or debt service as a share of government spending became very large. It became close to 20%. And that was what ushered in the realization within the fiscal and Congress that decisions had to be made. That was when PAYGO came in. That was when Grand Rodman Hollings was passed. This was a period of time when there was a realization that because you were paying so much in debt service, you couldn't do the other things that were the responsibility to your citizens with regard to government activity. It was a hard decision back then. It didn't stick. We never ended up with like a German style debt break or constitutional amendment against budget deficits. I don't think those are good ideas. I think they are constraint that end up being damaging, but something that does recognize that you are in a situation where you have to make the decisions. You have to make the decisions about what is the structure of your government spending, what is the structure of your taxes, and those have to be those are those political decisions that Mark is talking about. So we have to, and that also gets it to the point of monetary policy does have to normalize, because that is where you end up with debt service starting to be a constraint on political choices, and that forces the decisions to be made. But I think there's one other reason why we have to get to that point of monetary policy normalization. I mean, the Fed buying, the Fed buying bonds, all the government bonds. I mean, if from an emerging markets perspective, you look at that and you say that's financial repression. That is not a recipe for strong growth to be in that kind of environment. We've learned that from the emerging market experience. There is another element to that, which I also already mentioned, which is when you have a very low interest rates for a long period of time, and there's still remaining uncertainty about the pace of economic activity going forward, you get a translation of low interest rates into financial markets and asset valuations and credit spreads narrowing, and rather than real investment being undertaken to support the activities in the real economy. And that financialization, financialization of the economy disconnects Wall Street from Main Street. And we know that there are lots of wealth implications, wealth inequality implications, as well as populist type political outcomes that are a consequence of long periods of time of disconnect between Wall Street and Main Street. So, the onus, unfortunately, it is the onus on the central banks, yet again, to be the adult in the room and to pursue a strategy of normalization, which is going to be difficult. It's going to be hard on financial markets. We saw what happened in December of 2018. That was small potatoes compared to now, obviously, but at the time was a very big deal when, the normalization process was created a constraint. And it will create a political constraint as well because of the decisions that have to be made.
Yeah.
Let me finish by saying we can look at the very, very long history of the United States, going back to before the Civil War. Some of my colleagues, when I was at Brandeis, have had an article on this in AER, I believe. And there are three ways that you handle large debt stocks. One is you default. Two is you pay it off. Actually, there are four ways. One is you default. Two is you pay it off. How do you pay it off? Well, you can inflate it away, or you can generate productivity enhancing growth that allows you to pay it off and still do the other things that you want to do and have a stronger economy. When we look at the long history of the United States in terms of its public debt, almost all of the time that the U.S. paid off its debt, it was through productivity growth. And so I look at that history and I say, that's terrific. And then I say, so where am I going to see the productivity miracle? And that's probably a time for another conversation.
Yiping and Shanwen, apply the same question to China.
You asking question about China or about the U.S.?
The question now is about China, the debt load that has been taken on, the stimulus that is occurring, the buildup of debt in the public sector, and how is that going to be repaid, and what are the implications for growth?
Well, I think theoretically it's the same issue when you look at what happens in terms of the outlook. That's in part related to my final takeaway of the macroeconomic implications. After this pandemic is over, we might have to live with very high debt burdens around the world, very easy monetary policy conditions, and that might be called new normal, because exit always would be difficult. For China, I think the issue itself is probably less pressing. You look at the aggregate estimate of the government debt as a proportion to GDP. According to IMF, it's slightly above 50%. So you can add a little bit more. In fact, the criticism or the discussion in China nowadays is often that maybe the government should be more aggressive on the fiscal front. So for instance, the government always insists that our fiscal deficit should not exceed 3% of GDP. And a lot of experts are arguing that at the time of a crisis, maybe you should forget about this 3% benchmark for a while and get things done, and then you revert to the normal rule. And I think it's the same in terms of government debt. If we accumulate a little bit more going forward, obviously the Chinese economy is still growing at a reasonable pace. Even with a slower pace of growth, it's 5 or 6%, you have a better chance of getting it done. The other point people also often point to is when the government is spending lots of money in infrastructure, in physical fixed asset investment, you actually have a balance sheet with both assets and liabilities on the same balance sheet. So it's relatively easier for you to restructure. But I do agree, as I said at the beginning, I think the fiscal risk and the monetary policy implication are something we have to look at very closely when the pandemic is over.
When anything to add on that?
Yes, as far as China is concerned, I think the buildup of public debt to fight the coronavirus this time is very, very limited, partly because the government learned arguably the right lesson from what it did during the financial crisis. So when the coronavirus broke out this time, many people argue against eager fiscal stimulus because of the lesson draw from the financial crisis. So for China this time, the public debt problem is not a major issue. Another point I'd like to raise is that ever since 2018, China tried very aggressively to deleverage the economy, mainly to deleverage the debt of the public sector. And so far, it still tried very hard to stick to that policy path. So the policy response in China is quite different from what is being done in the United States.
Let's take some questions from the folks who are listening in. Barry Naughton, who's part of our Track 2 dialogue and is professor at University of California, San Diego. And he's asking Yiping, it seems as if there's a disconnect between the idea that the financial system is supporting many SMEs and households and the relatively modest expansion of lending. How effectively is financial support reaching SMEs and households?
Well, I'll make a couple of points. Number one, I do think the policymakers' focus shifted this time around. Something like from the Main Street to from the Wall Street to the Main Street. And you look at the monetary policy, easing off, targeted easing off triple R, the fiscal policy to reduce or waive some of the rental costs, some interest payment, and the Social Security contribution. And finally, the finance policy rule over some of the SME loans and allowing the small, medium banks to issue financial bonds about 300 billion and so to support SMEs. So I do think that number one, there was a shift of policy priority to pay more attention to the SMEs, supporting them. The second point, I'm sure I agree that that Barry is right. That the actual effect of that policy is probably less than satisfactory or ideal. But that's been a challenge that we've been facing for several years now. The government has been trying very hard in order to improve the funding conditions for SMEs. And some of the older issues remain. How do you find these SMEs? And number two, how do you do risk assessment for these SMEs? And particularly if the interest rate, the lending rate is not completely determined by the market, what would happen to the bank's balance sheet if you really go out to support the SMEs? So all these issues remain. Although I think we have seen some improvement in that regard. My final point is I actually think the greatest achievement in this regard that we saw was in the digital finance, the fintech sector. The online banks, they're extending lots of SME loans because a lot of SMEs already on the platforms of these big tech platforms, like Tencent's WeChat or Alibaba's Taobao and so on. So they're using these networks linking to millions and millions of the SMEs, and they do the credit risk assessment using machine learning approach and using big data information. And so for instance, if you look at the three main online banks in China today, Alibaba's MyBank, Tencent's WeBank, and also there is another online bank in Chengdu called XW Bank. They're using the digital technology to extending loans. Each of them nowadays, on average, is extending 10 million loans every year, and they're keeping the non-performing loan ratio at around 1%. So I think we are making progress with the support of the policy, but utilizing the digital technology.
I assume that's because Tencent and Alibaba have access to tons of data about these customers and can do credit analysis based upon the access to that data.
Well, you have the advantage of having big data, but they also have the machine learning approach. The credit risk assessment approach, we compared the big data approach with the traditional bank approach, and you find actually they could actually do better.
Great. All right, next question is from Dino Kuz, who is part of our Track 2 dialogue also, used to be at the Fed. And it's for Catherine, but he says also anybody else can answer it. What does this scenario, deep contraction and slow recovery, mean for emerging markets that rely on exports to the large economies? Will we see defaults from large emerging markets in the next few years?
Well, I mean, there are a couple of things that we can say about this, that certainly the long period of very slow recovery is damaging to economies, no matter who they are, who depend on global relationships as part of their strategy for economic performance. But I think that one of the points that Mark made, and that I absolutely echo, is that the tendencies and the pressures towards deglobalization are really being enhanced in this current environment. Globalization was already on the back foot. It's been flat in terms of kind of standard metrics of global engagement for more than 10 years. And it was further, kind of on the ropes last year because of the trade warfare between the U.S. and China. And so a number of the factors that have all come together to really worsen the environment for globalization. Mark mentioned immigration. We've done a lot of work on the implications of the sort of reduced appetite for immigration and the implications of that for remittances. Remittances have become a very important component supporting economic activity domestically in a lot of emerging markets, and remittances absolutely have dried up. So there are a number of different ways in which deglobalization is a stark feature of the prospects going forward. And so it's not just COVID, it is COVID in addition to what has already been a pressure to deglobalize. What this does sort of imply is that emerging markets, and this is something that we've, many people who've looked at emerging markets have talked a lot about the need for domestic house in order, and to have sources of domestic demand be an important underpinning for economic activity. This is not to say that you should deglobalize, but it is to say that having a dependence on a current account surplus, meaning exports greater than imports, a dependence on current account surplus to be supportive of economic performance internal to your country and be the source of ability to repay obligations, that always was a vulnerability. And there was a lot of pressure over time to balance that relationship between the domestic source of demand and the external source of demand. So now it's being forced. Now it's being forced on economies, and it's always very challenging to address a situation when you're being forced to do it. In terms of there are a range of emerging markets right now who are facing challenges with respect to their debt sustainability and debt obligations. There are a number of initiatives through the G20 and through the Paris Club to address those issues for highly indebted emerging markets. I think we have to look at the composition of the external debt that countries have. The composition has changed a lot since kind of the last time we did this. There's a lot more private. There's a lot of China, and then there is a lot of official. And it's maybe for a range of countries, it's kind of 1/3, 1/3, 1/3. And so that means having a coordinated strategy where where a deal with one group doesn't translate into paying off the other group, because that doesn't work well because everybody knows it's happening, and it doesn't end up being a strategic equilibrium when you're in that situation. So I think that is coming up with a strategy where official debt, private debt, and China debt are treated on an equal basis. That is going to make it even more difficult for some economies, but is crucially important when we think about protocols going forward for achieving debt sustainability.
Well, Shanwen, did you want to add anything to that from China's perspective? The Belt and Road, kind of the provision of debt to a lot of these emerging markets as part of the BRI initiative.
This is related to the discussion about the U.S. public debt earlier on, but I would say my own take is that out of a lot of on the list of the things that I will lose sleep about, the U.S. public debt probably won't rank very highly on my list. But I would probably not worry too much about the default risk. I would worry about slowing growth. I would first worry a lot about the potential implications for monetary policy and maybe the position of the US dollar as a reserve currency. But I will probably lose sleep about a lot of emerging market economies, given that what is happening now with a very easy monetary policy, especially once the pandemic is controlled. if the Fed and other central banks continue with the very easy monetary policy, we might start to see capital outflows again. Emerging market economies will enter another round of volatility, particularly when the Fed or other central banks start to unwind their QE policies. We might see countries with very high external debt, with large current account deficit, with large trade, with large fiscal deficit. These will be very vulnerable. Something like what we observed around 2014, 2015. I think that's something we should worry about a lot. And that's something I would also advise the Chinese government to be more prudent on the exchange rate, on the current account, on the fiscal balance, and also on the capital account.
Yiping and Shanwen, we've kept you up till midnight, which we deeply appreciate. So let me end with a question from a friend of all of ours who's also a member of the Track 2 Dialogue, former Treasury official Bob Donor, who asks, and I'll ask each of you to answer this question in just 30 seconds because we're already over time. Will this episode lead to a war on pandemics, similar to the war on terror, at least in the United States, that will help support the economy, but also change its character and provide much more support for research? So asking if this is going to fundamentally shift the focus of each of our economies. Whoever wants to go first. Bob, thanks for the question. This will be the last one, then I'll let you guys go to bed.
Well, let me just say, the U.S. economy already spends a tremendous amount of money in the area of health. So one can argue about the effectiveness of that spending. If I could say I would love to see more research, I would like to see more research on a broad range of things, basic research, money to be spent on basic research, but I don't see a war on pandemics as being the best use of research funding in the long term. I think we have a lot of research going on that right now. I would like to see a war on productivity slow down, and basic research helps to have the war on productivity slow down, because that ultimately is the source of potential output gains and the source of our ability to repay our obligations and make good on commitments to citizens.
The pandemic certainly reveals some of the weaknesses in the Chinese public health system, including the Medicare system. So I do think there are already lots of discussions about the need for the government to increase spending in strengthening that capacity, possibly including research, but also the general healthcare, public health system need to be strengthened significantly. And I think that's an area I certainly like to see a lot more spending.
Shanwen, anything you?
I'd like to add just one point. China's medical research has been making huge progress, partly because of the outbreak of the pandemic in 2003. After then, China's medical research has been making huge progress. Because of that outbreak, the spending on research improved, went up hugely, which contributed to the great progress ever since on. And also, this time, China's handle of the coronavirus is very effective. China did a quite good job, also partly because of the experience in 2003. And I have no doubt that after this pandemic, China will spend more on public health system generally and also on medical research specifically.
Mark.
Well, if history is a guide, we tend to devote a lot of attention to the thing that created the crisis and work to fix it. Financial crisis, we had Dodd-Frank. After 9/11, we did a lot to harden our ability to digest and mitigate terror the risk of terrorism. I think every crisis we've responded that way. And I would expect if that history is any reasonable guide, we do that again. And, you know, it's not only about pandemics, it's about just making our healthcare system work better when it's under such tremendous stress. And we will, I think, spend more resources on it. But I'll end by saying, I think it depends on the election. I think if the current administration remains in place, that is much less likely that history will repeat itself, and that we will address this in a fulsome way. So I really do think it matters on the political environment on the other side of this election.
I want to thank our panelists, especially the ones from China, for having a frank, informative, interesting conversation where I learned a ton. I should say that though it wasn't, I think, an optimistic view, given that the indices, the stock indices went up 2.31% during the course of this conversation. I looked at it when we started and I looked at it just now. So we've seen a significant increase, and it's, I guess, based upon a test of a viral therapy of one of our corporate members, Gilead Sciences, which seems to have had some positive results of a test that they have run over the last few weeks about a therapy. But thank you all so much for joining. It's the first of 3 of this series. And I thank you all for participating in our Track 2 dialogue and for doing this virtually when we usually, last time we did it over at Citi's offices, and I guess in July we'll do it virtually, the Track 2 for the first time. But thank you all for joining us. I really appreciate it. Bye now.
Bye.
Bye.
Bye, Steve.
Bye.
Thank you and goodbye.